Good morning. So we're going to get started as Megan rolls us into Facebook. We're going to get started with the quote. What an incredible weekend last weekend was. Got an amazing buzz going in the market. Now, you might say that we're still down in inventory and buyers don't have a ton to choose from yet. But I do know that there is a buyer activity that's increasing. Megan is going to talk about inventory. I was asking her, how's our inventory levels? Because nationwide, we're about to break below 1 million nationwide, which is huge. I mean, that's low, really low. And so if we can kind of keep up our inventory as these buyers come back on the market, as we see interest rates moving around a little bit and take advantage of that, I want to take advantage of the buzz that I'm feeling in the market right now. So that's where my quote is. It's simple. It's be happy in anticipation of what's coming. I mean, guys, spring is here. We had this massive recalibration year last year that if I take 2022 and add it to 2021 and 2020 and I divide by 3, I start to feel normal. So that's what's happening. It's this recalibration towards normalization. We still have some of that to go this year as inflation comes down and we start to get into a normal real estate cycle, which I know you're going to be talking about. So we're going to be talking about that. We're going to be talking about the CPI that came out this morning. We're going to talk a little bit about the unemployment report that came out on Friday and a miss on what I expected to have happen last week when we talked on Thursday on the back half. But why don't you tell us what's going on in the real estate market?
You know, it's exciting to see the market start to pick back up again. The last 2 weeks of the year were just so incredibly slow. And I woke up the Tuesday after New Year's at 4 o'clock in the morning and it was like, okay, I'm ready for something to start happening.
Yeah.
And so it really put a damper on the market with the last 2 weeks of the year, with the holidays falling on the weekends when you're typically out showing properties. So we were down even further in market production during the last 2 weeks of the year than we were previous years in our real estate cycle, where the holiday would fall on a weekday.
Right.
And so again, it really took a hit in the marketplace and everything slowed way down. And so if you were a buyer in the market, you had a really great opportunity to have some negotiating power with some very serious sellers that were still in the market even through the holiday period. We saw our nice purge of expired and withdrawn transactions at the end of the year that helps drive inventory down and fuel our spring market so that we can hopefully start to see some month over month appreciation. I still don't think we're going to hit the historic highs that we did in 2022 just because the market conditions don't exist that we saw, and the relationship between supply and demand has shifted very greatly since then. But the good news is buyers still have negotiating power,
right?
And that's a wonderful thing, but I think they only have it for a short window of time. So they really need to be in the market now to take advantage of what's happening as more inventory starts to make its way to market.
And that's a hard conversation to have. So like double click on that. You know the secret, right? We know that the inventory right now has sellers that want to sell and we have eager buyers yet at locking in at higher interest rates. Yet we know that that's going to start to pick up. We're going to see multiple bids. You're already seeing multiple bids on homes that are coming out priced right, staged right, and in appealing neighborhoods. They're already going for multiple bids. But buyers have been pressured for like 6 months. They've been operating out of fear. So you're trying to tell them that now's the right time without being like that I don't even know, what is that salesman that just won't shut up. It's like, so, and you have to be careful of not being too eager, but we definitely have to educate, because I do think that the buyers who have been priced out of the market, feared out of the market, they have this little window, and yes, they can refinance, where they are going to be able to get a deal, get the sellers to buy down the rate and put themselves in a better position.
They do. And so this is a year of strategy and not of speed.
Yes.
And so it's really important that you guys are taking advantage of the market now before things really start to kick off. We don't know when interest rates are going to go down or if they're going to go down this year or not. That's why buy downs are so important right now. And you have the opportunity to have the seller pay those down for you.
Right.
And so you won't have that opportunity if rates do go down at some point this year. A compression cycle will kick into phase and we'll probably end up seeing multiple offers and some of this pent up demand get flushed back into the marketplace again. And so to take advantage of it now while inventory is low, but they still have the ability to come through and negotiate. We're still seeing a lot of price reductions as people are trying to find their way through the marketplace. And we're not going to see the extreme bidding wars that we saw in 2021 or 2022. And so it's important that you guys are getting out there and getting things under contract now rather than waiting.
Agreed.
So we'll go ahead and flip into the screen. We have a Q&A already popping up, already starting to see some multiple offers, but the offers are below asking on most. That's really interesting to see multiple offers that are going for under asking price. Just got my seller under contract this weekend, multiple offers, and ended up above list price. Buyers were surprised to be in that situation in this market. And so yes, it is happening because our inventory is still low. Now, again, what the market is talking about and the media is talking about is how high up we are in inventory, and they're looking at year-over-year numbers. And that is true year over year. But what I'm projecting is that we're going to have a return to a more seasonal cadence like what we saw from 2013 through 2019. And I could almost set my watch to the market from 2013 through 2019. So I'm thrilled to see this normal seasonal cadence kick back into play as I start to put together my projections for 2023, because I have a more cyclical market that I can rely on to have good data to give to you guys so that you can advise your buyers and sellers about what's happening in the marketplace. We'll go ahead and start sharing actually this one. And we'll get this going for you guys so that we can look at what's happened just in the last week. And so looking at what's happened just in this last week, we ended up seeing that this is for the month or the week of January 4th through the 10th. Looking at what's happened over the last couple of weeks, we were really slow from Christmas through New Year's, and then things started to pick back up again. But here's my projection, and this is based off of data from 2013 through 2019. Up here across the top is your target listing month and your target closing month right here. And you can see in January and February that some of our cells start to line up and turn red as our market really picks up. The longer that we remain in a market that's considered to be an extreme seller's market, the earlier our buyers start to show up to the game. Now, are there football games this weekend, or is this a bye week?
Don't ask me.
Okay.
And so somebody can Q&A. They can let us know. I don't know.
Q&A. Let me know if there are any playoff games this weekend or not. But honestly, this is probably a good week to be a seller in this market, because after the Denver Broncos are done playing games, we end up seeing a little uptick in showing activity as people aren't staying home to watch the football games. The next big uptick of activity tends to come right after Super Bowl weekend. And last year, based off of data, and this is 2022, you can see that back here in February, we had one really red row that came through, and that was the week directly following the Super Bowl. Now, as I put together my projections for 2023 and we start to look at our heat maps, it doesn't really make sense to look at this quite yet because we don't have enough cells and data to show that the market is warming or cooling with just our first week in the market. But you can see that the market is starting to take off already. Now, what was really interesting to see is that our average daily active count continues to decline, and it declined by about 6.9%. A lot of those brand new listings are starting to get absorbed into the marketplace and going under contract very quickly. And it's not the first time that I've heard the story of there are multiple offers. Now, is it the multiple offers that we saw in 21 and 22 where you were getting 20 or 30 offers on a property? No, but I'm still hearing stories of getting 2 to 5 offers on a property. Even though they may be under asking price, you're still in a situation where you're in multiple offers. It's not going to drive the market to the frenzy that we saw in 2022, but it is going to help with price appreciation month over month. And we may see some of those month over month price gains after having 6 months in a row of falling prices as the market adjusted to higher interest rates. And so we are still up 270% from where we were 1 year ago in terms of our active inventory. But that's great news for buyers, is that you have more choices this year. That's a significant difference about being in the market this year rather than last year. And again, you have negotiating power right now. We did see back on markets pop up by about 16.6%. We saw nearly 800 listings expire last week. There are a lot of those contracts that renewed with the new real estate contract for 2023 and relisted. So our back on markets tend to be up for the first couple of weeks of the year, but it's not because contracts are falling apart and then coming back on the market. It's because they were in an off market status, so they were expired and now they're being relisted again. Expired listings were down by 82.4%, but they're still up year over year by 180%. Withdrawn transactions were down by 15.3%, but year over year, they're up by about 40%. Our pending transactions, just going from the holiday season into our first week of the year, increased by 61.9%. So that was a nice little pop of activity where perhaps people who had New Year's resolutions decided now's the year that I'm going to go ahead and buy a house. And so they got into the market, they got under contract, and we put 685 units under contract last week across Metro Denver. Now, with that pop of activity and our active inventory going down, it took our month supply of inventory from the last 2 weeks where we were bouncing between 2.5 to 3.5 months worth of inventory back down to 1.5 months worth of inventory. And so again, our market has become much more competitive just in the last week. And what we expect to see is that number tends to drive down for month supply of inventory going into the next couple of months. In March, it starts to increase again as we start to see more listings make their way to market in March and April. But I don't really expect there to be a whole bunch of new listing activity, probably until a little bit later in the spring, until March and April. But it's good to see that the market did pick up as we expected it to the week directly following the holiday season. But again, 1.5 months worth of inventory indicates that it's extreme seller's market territory, being south of 2 months worth of inventory. So again, it's not the lows that we saw last year where we were down to 0.2 and 0.3 months worth of inventory. But right now at the current rate of sales, it would take about 1.5 months to sell out of the existing inventory. We also saw a nice bump in the odds of selling. So if you listed your house last week, in the next 30-day period, you can have a 48.1% chance of getting your home under contract. Again, the odds of selling is basically where I take into account all of the available listings for sale versus those that go under contract and or close in about a 30-day period. And so again, it's not the highs that we were seeing about a year ago. We're off by about 35.2% from where we were 1 year ago, but this is right on pace with where we were from 2013 through 2019, having about a 50% odds of selling during the month of January. So we're getting back to that normal seasonal cadence that we were used to from 2013 through 2019. I'm still not concerned about a market crash. We ended up seeing that our predictive months, or our average daily active units to create a balanced market, or to create that magical 6-month supply of inventory where we would transition from a seller's market into a buyer's market, ended up going way up. And so with all of the new demand that came into market just this last week, we ended up seeing that there were 17,879 units that we would require to have a balanced market. So that means that we only have 25% of the inventory required to offset demand right now. And so again, that number is being driven down. Historically, that number continues to go down as we get into the spring months, going into February and March. So watch for that number to tighten up a little bit more as we go into a compression cycle. A compression cycle exists when we're putting more homes under contract than we have active listings available for sale. And so again, that tends to happen as we go into February, March, and April, and historically a little bit of May, but that's what helps drive our prices up, and it drives appreciation. 95% of the appreciation that we establish each annual cycle is established between the months of January through June. And so hopefully we'll start to see some of those price gains after having watched our prices fall so much over the last few months. Showings ended up going up pretty drastically. So we saw an 80% increase in the number of showings just in this last week. It's still down by 51.2% from where we were 1 year ago. So a lot of people were driven out of the market, but are now returning to the market in order to get a home under contract, hopefully in 2023. But that means that you should have had about 2.5 shows per property per listing. And that was a 94.1% increase over the last week. And so again, looking at the 3-strike rule, how do we know when to make a price reduction is watch what's happening with your showings. And I have this broken out for you in $500,000 price segments so that you can watch what's happening with your showings so you know when to make a price reduction. One of the biggest mistakes that I'm still seeing agents make is if they're not under contract in weeks 2 or 3, they're making these massive price reductions, but it's taking longer to get people through homes. And so you need to wait to make those price reductions. Back in like 2010, 2013, we were looking at, it was you'd be on the market for 2 months before you'd make a price reduction. And I'm not saying wait 2 months, but if you're not getting 2.5 shows per property per week, you may not be in your target strategy zone for the appropriate pricing for your property. And so that could be strike number 1. Strike number 2 would be if you've had a total of 16 showings and no offers, that you may not be in your strategy zone. And what we're seeing now is that buyers are looking at more homes before going under contract. So we have a lot of looky-loos that are interested in the real estate market, but they're not necessarily putting homes under contract at the same rate that we were seeing last year. This number has bounced between 12 to 14 towards the end of the fourth quarter of 2022. But now again, they're looking at 16.2 properties before going under contract. So if you've had a total of 16 showings and no offers, you may not be in your target zone. So if you're getting 2.5 showings per property per week, and it's taking 16 showings to go under contract, that's in line with our median days on market, where it was 43 median days on market for what went under contract last week. Historically, we start to see median days on market decline as we get into March, April, and May. And so hopefully we'll continue to see those days on market start to decline as our buyer pool starts to wake up from our sleepy winter months and adjusting to higher interest rate environments than what we've experienced for the last couple of years. But again, buyers have a nice opportunity right now where they're able to have a more leisurely strolling and looking opportunity to go through and look at homes rather than going in and having to make offers sight unseen. So hopefully what they're able to do is have that negotiating power to get those inspection resolution items cured and also have some rate buy downs to take advantage of in this marketplace. Looking at price reductions for this last week, it dropped down to 50.2% of what went under contract last week made price reductions, with 48.5% making no price reductions, and a few properties increased their price at 1.4%. But price decreases were down by 8.2% this last week. So people are starting to get back into the flow of pricing these properties appropriately. If you're looking back at comps, we're right in line with where we were last year at this time of year for comps. And so looking at average sales prices for 1 year ago, minus the big run up that we had from January through April, 1 year ago, we're sitting relatively flat in terms of our average sales price. So looking back 1 year ago for our comp prices. Looking at what the size of the price reduction was, the size of the price reduction also came down. We were experiencing major price reductions for those sellers that were really interested in selling in 2022 towards the end of the year, where they were making 7 or 8% price reductions off of their original price. Now we're down to a 6.4% price reduction, or about $44,500 off of their original asking price. So it's good to see that price reductions are starting to fall back in place. Historically, we see about a 5.6% price reduction in from 2013 through 2019. So price reductions are still a little bit higher as we try and find our footing in terms of how to price appropriately in this market, but it is about a 6.4% price reduction based off of what went under contract last week.
Can you go back and talk about, you had just said as far as using comps from a year ago, we know that last spring we were really hot and people were paying over asking.
Yes.
And then that died off in April. So if we're using the comps from a year ago during that period of time, given the fact that it had gone up, we lost some, but not all of it. So now it's leveled out to that period of time.
Yes.
Is what you're, okay.
Yes, that's exactly what I'm saying. Now up to $500,000, this is about 27.1% of our market. Again, there's a larger swath of opportunity to sell these properties. Demand is higher in these price ranges as affordability is kicked in. People are looking at lower priced homes, and the bulk of these homes fall along the 225 corridor and into Littleton and Lakewood, where we're finding these homes that are under $500,000. But looking at this, April is really your best time frame in which to list. Looking at March, it starts to warm up. May and then June is also a very good month in which to list for these homes. But if you have listings that are coming to market in early July or late July, they tend to get priced out of the market, and we end up seeing demand start to peter out by that point. Again, I don't have quite enough data to start showing a trend for our heat map for 2022 with just one line in there. But again, that'll start to build, and we'll watch the market warm up as we go into the next couple of months. Our month supply of inventory, well, our active inventory actually decreased week over week by 9.2%. We only had about 1,300 total homes that were available for sale that were under $500,000, and we saw a jump in pending transaction counts by about 47.2%. And so we did see that shift between the relationship between supply and demand. And so it drove our month supply of inventory down to 1 month. Now, again, if that ends up dropping below 1 month worth of inventory, that means that we could go back into multiple offer territory for this particular price range again. And so our month supply of inventory, while it is significantly higher than where we were 1 year ago by 487%, 1 month of inventory is still extremely shallow in terms of historical levels of inventory for this particular price range. And so again, 1 month worth of inventory and month supply of inventory has the tendency to go down as we get into February and March, and really doesn't start to pick up again until June. So again, we're entering a compression phase for homes that are under $500,000. The odds of selling jumped nearly 14.8% in just 1 week, increasing our odds of selling up to 58.2%. And so again, if you're listing a home for sale, last week was a great week to list your home for sale. I still think that your perfect strategy and timing is that week directly following Super Bowl where inventory is still incredibly shallow to get it to market. But if you have one of those cherry listings waiting until March or April to present that listing to market, once you have some solid comps to justify the prices of those properties that are going under contract into April and May, is your really good time frame for your turnkey properties. Looking at where we are for month supply or predictive, I'm really stumbling all over the place today. I've had 3 cups of coffee. This shouldn't be going.
I actually didn't think you were stumbling at all.
Oh, blah, 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 blah. I feel like my tongue is too big for my mouth today. So our percent of balance ended up dropping down to 17% in this last week. We would need to have about 7,500 total active units available for sale. So I'm not looking for a market correction. So we'll probably see some price gains as we start to see multiple offers come out for this under $500,000 market. We saw 3.5 shows per property per week. We saw an increase of total showings week over week by about 64.8%. It's still down from where we were 1 year ago, but it's encouraging to see that buyers are starting to get back out there and look at properties again. So again, strike number 1, if you need to make a price reduction, is if you didn't get 3.5 showings on your property last week. Again, people are looking at about 16 homes before they're going under contract. And so if you've had a total of 16 showings and no offers, it may be time to make a price reduction at that point. So we're starting to see more people looking at more homes, so they're being more discerning about their choices, looking for that perfect turnkey property. And that's one of the really key elements that buyers are looking for right now, is that they don't want a project. They want something that's been renovated. They want something that's turnkey. They don't want to have a lot of inspection resolution items on their properties, or they want them corrected. And so again, this year is all about skill and not about speed. And so you really have to be sharpening the tools in your tool belt to get those homes show ready and on the market and ready to go. Professional photography, staging, pre-inspected, having a home warranty in place to get those properties under contract to show that you're really serious about selling this particular property. Looking at where we are for median days on market, coming down from where we were over the past couple of weeks, we're now down to 35 median days on market. I would like to see this number probably drop to about the 20 to 25 range to get back on pace with where we were from 2013 through 2019, just so that we have some predictability in the marketplace, so that I can have some good gauges of what our opportunity looks like. Price reductions this last week, we were looking at about 46.9% of them making price reductions. So we dropped below half of the homes making price reductions, and 52.3% had to make no change at all to their price. Looking at where we were for price reductions, only 5.8% price reduction, which is down. We were seeing nearly 8.5 to a 9% price reduction on average for this price range back in the months of November and December. Now we're seeing a 5.8% price reduction, which is much more in line with what we saw from 2013 through 2019, giving us some predictability in this market. This is our largest category, between 500 to $1 million, with 60.2% of our properties represented in the $500 to $1 million price point. Again, looking at where you are in terms of your target listing strategy, getting into that week directly following Super Bowl. March, April, and May are your best timeframes to list these homes for sale. If you have one of those homes that isn't really show ready, maybe it's a little bit of an eyesore, I would recommend getting it to market sooner in this compression cycle rather than later in the compression cycle, because you'll start to be competing against all of those homes that are really beautiful and turnkey as we get into April and May. Again,
there's still, I want to double click on that, because I agree with you. And yet I feel like if interest rates drop and buyers can come in and still get a deal, I mean, I really do think it's going to affect, like we had the 2 folks who jumped in right before we even started saying, I had multiple bids under list and I had multiple bids over list. I wonder if it's almost going to turn into that. It's like the multiple people looking for the deals under list, and then the multiple people who are willing to pay so much more for it if it's show ready.
right.
Like, because we're still going to have light inventory, and I still think we're going to have demand. And I think demand is even going to pick up more if the interest rates go down.
Yes.
So it's going to be a very interesting market. There's going to be a lot to talk about.
Well, and it's really important that you guys are tuning into this every week, so that you're able to keep up with what's happening with these transitions, so that you have your strategy outlined in terms of how to advise your buyers and sellers how to navigate this market. We have nearly 1,500 people on this call this week. And so we've got a bunch of people that are watching this, and more people online on Facebook that are following along. And so we're so grateful for you guys. My distribution list has reached up to over 6,500 people that are subscribing to this content on a weekly basis with a 75% open rate. So I thank you so much for being able to tune in each week as we give you the twists and the turns. For the $500 to $1 million mark, we ended up seeing that average daily active count came down by about 7%. Again, as we went into the second week of January, our month supply of inventory dropped from having 4.2 months worth of inventory over Christmas week. New Year's week, it was 3 months worth of inventory. Now we're down to 1.6 months worth of inventory, which is a very healthy number for this particular market. It's still considered to be extreme sellers market territory. It's not as extreme as what we experienced in 2022 or 2021, where we had 0.2 and 0.3 months worth of inventory. But again, buyers have some negotiating power sitting at this 1.6 months worth of inventory. We did see 30% increase back on market, so people choosing to relist as we got into the new year. Our pending transaction count ended up increasing by 72%, going from just the week of New Year's weekend into the new year, the first week of the year. And so that was a nice pop of activity. We'll expect that number to continue to increase as we get deeper into the spring months. The odds of selling had a really nice pop of activity here, where we ended up seeing that our odds of selling increased week over week by 12.6%, or it's up to about 45.7% odds of selling right now. So if you get ready to list a home in the next 30-day period, you have about a 45.7% odds of selling in the first month that you're listed. Our predictive month supply, or I keep calling it the predictive month supply of inventory. I keep stumbling through this one graph. This is killing me. So our active units for balance, we would need to have about 9,500 units available for sale in this market to create that magical 6-month supply of inventory. And so we're again sitting at about 27.3% of balance, indicating that the market is constricted, and that drops just week over week by about 23.1%, speaking to the volume of the buyers that came out this last week. If you had a new listing that came to market, total showings increased week over week by 90.8%. So buyers were ready to hit the ground running in this $500 to $1 million mark. It's still down about 50% from where we were 1 year ago, but we still have about 90.8% of our total increase in a week over week for our total showings. Shows per property per week, we should have gotten about 2.2 shows per property per week for this $500 to $1 million segment. So if you're not getting your 2.2 shows per property per week, you might not be in your target strategy zone. People are looking at about 15 homes before going under contract in the $500 to $1 million mark. So if you've had a total of 15 showings and no offers, you might not be in your strategy zone. We saw about 55 median days on market. This number should start to cool and calm down as we get deeper into our spring months. In this price range, we saw 53.8% of them make price reductions last week, with an average price reduction of about 6.5%. So smaller price reductions as our demand starts to pick up. I've got 3 minutes to go through the next two price ranges.
Good.
Again, looking at the strategy sheet, this is for 1 to 1.5 million. This represents about 7.6% of our overall inventory. Really, March is your perfect time frame in which to list, and April looks pretty good too. May is not too shabby, but we expect there to be longer days on market as you get into May if you choose to list at that point in time. Looking at where we are for our strategy sheets, again, not quite enough data to go through and start looking at the actual trend. I know, it is so sad. When I started turning it over, I was like, I just hate this. It takes about 2 months for this to really start to make sense in this particular chart. We saw month supply of inventory over Christmas break going into 6 months worth of inventory. Over New Year's week, it was 42. Now we're down to a very healthy 3-month supply of inventory, with our average daily active count dropping by another 6.3%, with only 310 total units available for sale. Our pending transactions increased by 33.3% going from New Year's week into the new year. So it hasn't quite picked up like what we've seen for the under $1 million market, but that market is definitely coming. They tend to hit a little bit later in the year. So again, your target time frame is probably about March for your perfect strategy for listing. We ended up seeing that the odds of selling week over week increased by 11.1%, or up to 38.3%. In this market, we would need to have about 940 units available for sale. So we still only have about 33% of the active inventory that we require to offset demand. Your first strike is we ended up seeing that showings doubled as we went from New Year's week into the first week of the year, where we had 610 total showings that were set between 1 to 1.5 million, or you were getting about 2 shows per property per week. So you should have seen a nice little bump in your showing activity for 1 to to 1.5 million. Looking at this, we were looking at 25 showings to go under contract, which is kind of an anomaly. And so again, we ended up having only 24 units go under contract last week. So a lot of looky-loos out there looking at this particular price range, just waiting for that perfect home to come to market. So it was 25 showings to go under contract last week. Median days on market dropped down to 27. We hit a high over Christmas week at 62.5%. So again, those homes that are perfect and turnkey and ready to go are going under contract very quickly, versus those that aren't are sitting on the market and hanging out a little bit longer. Only 39.1% of these homes last week made price decreases, with 60.9% making no price changes whatsoever. And the average price reduction was down to 7.7%, whereas we've been bouncing between 10 to 11% of a price reduction in some of the weeks leading up to the end of the year. $1.5 to $2 million. Looking at your target time frame, February, March, beginning of April is really your target time frame. You can see how much my strategy sheet starts to break down the smaller amounts of data that I start playing with. But again, your target time frame is really looking at this March time frame in which to list in. Sad little strategy sheet there with only 1 week of data, but our predictive month supply of inventory over Christmas week was sitting at 6.5. Over New Year's, it was sitting at 7.6. and it dropped down to 2.4. And that's in large part due to our active inventory going down by 5.3%, but our pending transaction count rose by 200%, going with 12 units going under contract this last week for the $1.5 to $2 million mark. So it pushed it down to 2.4 months worth of inventory, which is a very good number for that particular price range. We ended up seeing our odds of selling increase week over week by 23.2% headed into the new year. So the likelihood of you going under contract and or closing in the next 30-day period in this time frame is about 37.5%. So that was a great increase in just the last week for this $1.5 to $2 million mark. In this market, we would need to have about 626 available units for sale. So we're only sitting at 20% of balance. Gosh, I'm flipping all over the place. 20% of I'm struggling today, struggling. So it's a 20% balance right now in this particular market. So again, this market is really driven down and is becoming much more competitive. They're less dependent on what happens with interest rates. So they don't really care what's happening.
No, they don't.
40% of those people are cash transactions. So they're going under contract very quickly. Shows per property per week went up to 1.7 shows per property per week. So if you didn't get your 1.7 showings last week, that could be sign number one that you need a price reduction. Looking at shows to contract, it was 17.6 shows to go under contract. So a lot of looky-loos, again, people that are out there looking, just waiting for that perfect home to come onto the market. Median days on market dropped from where we were back over Thanksgiving week at 99.5 median days on market down to 43 median days on market. And that number is likely to continue to decline as we get into the next couple of weeks. Going into price reductions, only 36.4% of these homes had to reduce their price. So much smaller amounts of price reductions at higher price ranges with higher demand. And the size of the price reduction, though, was very large. There was one property in there that made a $300,000 price reduction, but it was a 16.5% price reduction. Don't put a lot of weight into that. We're bouncing closer to a 6 to a 9% price reduction when we look at this overall. And so that's all I got for you. We got a lot of questions to try and run through, getting into this next portion before we turn it over to Nicole. Are you discussing price reductions during listing appointment versus waiting? I would always have that conversation up front to know what your strategy looks like and say, if we don't get X number of showings per week, or if we have X number of total showings and no offers, or if we're on the market for this long, we should probably go through and make a price reduction.
It's good to set the rules.
Yes,
right.
It's good to set those expectations up front.
Absolutely.
Yeah, so that you're not circling back
by this.
Yes. Nicole, do you offer a 1-year buy down for a smaller concession from the seller?
We do. We have a 3, a 2, and a 1.
Yes, playoffs on Saturday and Sunday. So we might not. Okay, so thank you for that. Lots of games this weekend. So it might not be quite as busy, but maybe some people will be out there looking as we get out there. What do you see for the downtown condo market and your heat map? So that market is sitting at about a 4-month supply of inventory right now. So it is one of our cooler spots, along with just south of the airport and out into Elbert County. We're seeing slower market activity right now for 80202, which is the downtown Denver zip code. Median days or average days on market is about 65 in that particular market right now, and close to list price ratios are coming in at around 97.5%. Looking at, so thank you, Megan, stats on all counties in Metro Denver. Thanks, please forgive if it was already said. I track the 7 Metro Denver counties, so Adams, Arapahoe, Broomfield, Denver, Douglas, Elbert, and Jefferson. I don't trend Boulder County.
Can you say those backwards?
No, I can't. I have to say them in alphabetical order. That's how I search for them whenever I'm putting these reports together, is that I search for them in alphabetical order. So, so I can't remember, do your reports include the $2 million market stats or more? In the monthly reports, you'll find those $2 million plus. Once we get into such a small portion of that market, going over $2 million, it's not enough data for me to track on a weekly basis. But in the monthly reports, so when you look at the attached and detached residential reports, when I send them out today, you'll see those in there. Do I have a newsletter with this information to subscribe, or just these calls? Don't want to miss anything that you put out. Awesome. Thank you. So if you've signed up for this webinar, you will get a follow-up email from me today and forever until one of us dies. Every Thursday at about 11:30 in the morning, I send out all of the slides plus a synopsis of what's happened in the last week and some projections going into the next week.
And a note, if you're not getting the emails from either Megan and I, and you didn't unsubscribe, then they could be landing in your junk, or your brokerage could have them flagged. So we've gone through that a couple of times and moved some folks over to personal emails. So just wanted to make sure that you knew to look for that.
Yes, definitely. Do we break down the data between condos, townhome, and single family? Yes. There are 2 sister reports to this that I put out on a monthly basis that you can go through and look at that for both attached and detached residential. You'll get a copy of those today. Are the trends different for condos versus others? The condo market is actually tighter than the detached single family market right now, with the exception of Lodo. And so the attached market is actually hotter right now because of affordability issues, where we're seeing more markets and more competing offers for attached residential versus detached residential right now.
How are you seeing it? What's the appreciation levels? Are you seeing the price increases on the condos different from the single families?
Yeah, single family, we ended up being flat year over year versus attached single family. I think we were up about 4.6%.
Because of that demand, because of affordability?
Yes.
Because typically you see greater appreciation on the single families, on the detached, but it's interesting in a market where we've got factors that aren't normal, right? When you have these high interest rates and you have affordability. So we're going to go ahead and get started. I'm going to share my screen. I'm going to do it like you do it. All right. So here we go. And then where do you go from there?
Slideshow.
Oh, look at you.
From beginning.
I want to be like Megan.
But it always gets stuck and then it completely messes you up. So I got to be careful about making sure I shut all of my windows before I turn it over to you.
Oh, technology is fantastic when it works. So we're going to run through some things that are happening on the economic front. I know Megan was running over. I was like, go. There's a handful of things that are happening, and there's definitely things that we're watching. And I want to give you more of that information than anything else. I'm going to tell you what the CPI did, but it ran a little flat as far as the market reaction to it. But let's go over what I saw, what we're watching, and then a conversation that I'm having so many times a day that if you're not having it, you're missing clients. So we're going to bring that up as well. Literally, it's like at least 6 times a day that I'm having this conversation, and it's opportunity. So yes, started out with my quote. Let's jump into, it's so funny because I was like, okay, so the next big thing, you guys have all heard about it. You just got to get out there and get the tickets. We did sell a really strong number. We're going to have a packed room, phenomenal speakers, the whole thing. The sponsor lineup is off the charts, and CAR and RE Colorado and DMAR getting involved. And they're going to help pick this up even to higher levels in years coming up. So can't be more excited about that. So let's start off with the CPI, because that seems like the most relevant conversation to have, considering it just came out this morning. So it was dead on. That's the news. It was flat. Like, it didn't surprise the markets. We were so hopeful. So we had a really good treasury sale yesterday. If we then today had a lower than expected CPI, and we had more people file for unemployment, meaning the initial jobless claims, we would have seen rates tumbling down and breaking through some resistance levels. Now, what we're seeing is rates are moving around. We gained a little, then we lost it, and now we're gaining it again right now, but in a very narrow range, because the headline CPI came in exactly as expected. But the one thing that it did do is month over month, we were actually down. We have not seen that in a while, a long while. So month over month, we were actually down. So we've been doing this for 6 months. Headline came in at 6.5. Big part of this was gas prices. Gas prices dropped 9.4% month over month. And I'm sure you were seeing that. Core CPI came in again, exactly as, oh, are they not changing? Oh, no, it's two different.
Okay.
This, let's make sure. Oh, are you guys seeing the screen share though?
Yes.
Okay. No, you're seeing it. Okay.
Yep.
All right. Yeah, they look identical.
Okay. I'm like, wait a minute, it's not flipping.
So this one is core. So it just shows the difference. So it's only been going down for the last 3 months. So remember, core strips out food and energy. So it was exactly as expected. Half of this though is rent. So I want to kind of talk about that just for a second, because Fed Chair Powell did come out saying that they might have to look at a different metric than the one that they've been looking at, which is the owner's equivalent of rent. Because as I look at this, if you start taking the last couple of months, inflation's actually dropping, especially if I annualize it. If I annualize a 0.3% month over month, it actually makes the annual inflation 3.6, not these numbers of 5.5 and 6.5. But we have to get there, and a big part of that is rent. Rent was up 0.8% this last month, yet we know it's coming down. In fact, 2022 year as a whole only came in at 3.8, which is really pre-pandemic levels. We could actually see rent go negative. And if that happens, though, we're like on a 3-month lag between what we're feeling in the market and what the owner's equivalent of rent shows up in the inflationary numbers, which is why the Fed is now talking about, do we need to rethink that number as we're looking at overall inflation for the marketplace? If I take core CPI, the core inflationary number, and I remove the shelter, we've actually been negative the last couple of months. So therein lies the conversation. So we're looking at the CPI, we're looking at the PCE, which is going to come out a couple of weeks from now. That's the Fed's preferred measure of inflation. Yet if we remove core, which we know is lagging, we're already there. So there's, it's like the cart before the horse. The market is already baking this in. The market is like, the Fed's not going to do what they're saying. They're just being rather hawkish. They're trying to keep the market in check. Yet the market reacted, especially to Friday's news, rather excitedly, because we see this. We see that the rent is a big part of it, and we see that the rents have already gone down. Interesting flip side to this is the vacancy levels. So the vacancy levels went way up at the beginning of COVID due to fear and uncertainty. It came down due to this rapid household formation. I mean, everybody was taking advantage of the low interest rates, and they were forming new households, multiple households. It's going up again. That vacancy rate going up with new build apartments coming online, and we know that because we've been seeing the permits and the starts in the multi-unit higher than the single family, that is going to create more units. Vacancies are going to continue to go up, putting downward pressure on rents, allowing those rents to go down, allowing inflation to go down. All of that is going to help our interest rates and help affordability. It all circles back, right? Unemployment came out on Friday. So I just want to double click on this just for a second. It's kind of old news by now, especially if you get our Saturday emails where I talked about why exactly the rates went down if unemployment went down. Because on Thursday, I said if the unemployment number comes down, if the employment number goes up, we're going to see rates get better. Yet the unemployment number went down from 3.7 to 3.5. The last month was adjusted, but it went down, and yet the rates still got better. It was all baked into the rates or the wages, sorry. So the wages did not increase as much as expected. So they only increased 4.6%. So wages are still going up. They're just going up slower. The average hourly gains of 0.3% is really something we want to double click on. So not only did the average hourly earnings go up slower, but workers actually worked less. So they actually went down 1/10 of an hour, which you're like, what does that matter? Right? You're talking about like 6 minutes, right? Is that what that is? If I take 6 minutes, all the workers across the United States, that is equivalent of 379,000 jobs. So job count would have actually gone down, which would have helped our numbers, but that didn't happen because instead employers are trying to hold on to their employees, not letting them go and just reducing their pay and reducing their hours. So that's what we're seeing right now in the marketplace. All of this is just impacting the interest rates, inflation, our feeling of job security. I mean, that is where all this is coming into, how well your buyers are, how good they're feeling. Now, remember, the consumer confidence is still high. PMI also came out on Friday. This is one of the big reasons. So besides the fact that wages didn't go up as much as expected, the amount of hours worked went down, and then literally an hour later, the PMI services report came out. And then this is just measuring those manufacturing. So you think of manufacturing of goods, manufacturing of services. So you're talking about wholesale numbers. The PMI for services actually went below 50% for the first time since 2009, if you exclude COVID, right? The massive drop. So when I look at this, new orders are down, employment is down, inventory is down, exporting orders are down, all of those things, and even prices are going up, but they're going up slower. That first time going into contraction is simply saying that the economy is slowing down, which is going to improve the inflation, which is going to improve our interest rates. So this was good news. The market celebrated it. The stock market celebrated it. Our bond market celebrated it. And we walked into the weekend with a lot of mortgage purchase applications because the mortgage rates went down. So that is what happened on Friday. PMI came out, orders from consumers are softening, orders are being canceled, loss of employees, all of these things, which we talked about last week, all of these recessionary factors. And we talked about the probability of a recession was as high or higher than it's ever been. So this idea of a recession, it doesn't have to be deep and it doesn't have to be long. It just has to slow down the economy for 2 quarters, theoretically, which really is the consumer spending portion of the slowdown. So those consumers spending less, which we are starting to see some of that. We're seeing them spending out of their credit cards and out of their savings accounts. And that runs out. You don't have any more savings, or your credit cards tap out, or you just realize you don't want to spend any more of your savings. You want to hold on to it because overall the strength of the household is still good. It is still good, especially those who own their homes. Because historically, remember, the benefit of owning a home is that your wages go up every year, but your home payment stays fixed. So wages had been going up, and then during inflationary times, wages go up faster, which is what we saw, which is what is kind of spiraling this inflationary issue. So the wages were going up, which was kicking inflation up even higher, yet their home prices went down because the interest rates went down. So everybody refinanced. So really, they improved their household finances by their wages continuing to go up and refinancing and locking in that lower interest rates. Homeowners today, they're good. Like, they're really good, which is going to be the problem on inventory this year because they're not going to want to give that up.
It's going to create this really interesting level of inventory gridlock where people have locked in at a 2 or a 3% interest rate. They don't want to go through and list their home to buy a smaller house for more money.
That's right.
And so it's going to create inventory gridlock for a long period of time. And people are going to choose to stay in their house and renovate rather than to move. And so this is something that's going to take a lot of years to unspiral.
It really is. And especially if you think about that Bank of America survey on the millennials, not on the millennials, on the Gen X? The Gen X and the baby boomers, that a lot of them they picked the home. This is where I'm staying. I'm retiring in this home. I'm fixing up this home. I'm making it age appropriate. So on Friday, we saw this nice little drop right over here. And that was all due to those indicators that I was just talking about. Yes, the unemployment went down, but the wages, the hours worked, and then the PMI services all gave us a really nice benefit in interest rates. So when that goes down, our interest rates come down as well. That's the index. Small business optimism is still coming down. They're still worried about their sales. They're still worried about affordability. They're still worried about, yes, the consumers are feeling good about their jobs. They're feeling good, especially if they're homeowners, about their finances, but they're pulling back on some of their spending. And that is what happens during a recession. So this is not a surprise, and it shouldn't surprise anybody that small business owners are worried about that. The initial jobless claims came out this morning as well, and it went down 1,000. And continuing claims went down as well. So we're finding that people are either, if they're being laid off, they're going right back to work, or even the folks that were on continuing claims are starting to find jobs. So we're still not out of the woods. I still think we're going to see more layoffs. I still think that there's companies that overhired during COVID, but those people are just being recaptured by the workforce.
Mm-hmm.
Yeah, and other employers are looking for them. Our mortgage purchase applications went down 0.5%. So you'll see a lot of reports that it went down 1%. It's a rounding. Mortgage refinance applications went up, but mortgage purchase applications dropped off after the holidays. We talked about that last week, and now it just stayed there. This is not good. That demand is there. Now, personally, we saw a ton of activity. You guys saw a ton of activity. This is a national number. It's really hard to get a mortgage purchase application for the Denver market specifically. We were very busy last week and the buzz level was off the charts. I was so happy about that because people are stacking up. Now, some of them couldn't find the homes to get under contract, but they're stacking up. They're getting ready. Let's take advantage of that property as soon as it comes on the market for sure. But we saw that little right there. Why is that a 5% refinance gain? I don't get it. But we did see a little bit. I think we still have more to go. I wouldn't go calling all of my client database and tell them to refinance yet. But if somebody was looking to pull cash out, especially before, as I mentioned last week, the refinance rates are going to get worse. Now, if interest rates come down enough and then the LLPAs, the loan level price adjustments that we were talking about go up, do they offset each other? But we are seeing a little bit more of that taking the cash equity out before those changes come into play. But I think interest rates are still going to go down. I wouldn't go rushing out to refinance quite yet. Inventory nationwide, we were talking about this, is about to break below 1 million. Here locally, we're looking relatively seasonally normal. But if we continue to see that, and if people move around the United States looking for opportunities as inventory nationwide is lower, this will continue to prop up our home prices. Now, we're not going to see double digits and we're not going to see massive home price appreciation this year, but low inventory. And if a little bit of a drop in interest rates, we are going to see that prop up so that we could end the year, depending on how soon the interest rates go down, we could end the year healthy. I mean, remember, 2019 was like 2.5% gain in median home prices. So as we look at this, I'm not worried about this at all. Freddie Mac just came out with their housing sentiment report showing that the confidence in the housing market is going down. And I get it, right? So 34% are confident in the housing market. And really this number is hit most by the 50% of buyers, not homeowners, 7% of buyers concerned about making their housing payments. Right now with affordability, high home prices and higher interest rates, this didn't surprise me at all. So it's just a waiting game to see these buyers coming out as interest rates going down. But ultimately, it's a numbers game. When I go in and dig into this report, 21% are saying that they're likely to buy in the next 6 months. It's actually an increase, even though the confidence level went down. Whatever, right? And 14% of homeowners are likely to sell. So that actually went down. So less homeowners are likely to sell, but more people want to buy. This will be the gridlock that you were just talking about. And a big part of the benefit is the birth rates are still on our side. Yes, I know everybody's talking about the fact that birth rates are down, and they are, but like for the kiddos, right now, we've got this really nice pop, 33-year-olds this year, 2023, and we stay relatively high. If I go backwards, even though we go down, we stay high. And then we have another massive pop in 2040. So this is a long game. This is about staying in front of your buyers, making sure that you're consistent and that you're relevant and that you're helping them kind of navigate what's happening in this market, because there's a lot of news coming at us that somewhat is contradictory. Like you have mixed signals coming out from the news cycles right now. We also have the strength of the housing market that's going to continue to support us. And I pulled this out of the most recent Black Knight report. So overall, 0.37% of all homes are going into foreclosure. Only 3% are even delinquent. And here in Colorado, that number is less than 2%. In fact, we're in the bottom 5 states. So looking at that, it just continues to go to the strength of our wages here in Colorado. Yes, home prices are up, but with locked in low interest rates, we've got budgeted monthly payments that work for the wages. we have a stability in our housing market that is not going to bring short sales and foreclosures to the market, and is going to keep a lot of people locked into those homes. So to see that strength and to see how strong Colorado is, it's really not going to be about taking advantage of opportunities. The opportunities that the buyers have right now is in those not so pretty homes, right? The ones that aren't necessarily show ready, the ones that haven't been maintained. That's the option for the rehab loans and for the fix and flip loans. We also have another little opportunity where we still have room to come down. So I've been watching this, and it dropped slightly off of the height, of course, but this is that margin between the 30-year fixed and the 10-year treasury. Because the Fed is no longer buying mortgage-backed securities, and because a lot of other people don't want to buy mortgage-backed securities at the high interest rates that we're seeing, because if you think about this, if I originate a loan at say 6%, but then the interest rates go down to 5.5% or 5%, or even 4.75%, all the 6%ers are going to refinance, making that long-term bond holding short-term. It's going to pay off that investment instrument. So nobody really wants to buy it yet because they know that those are going to be refinanced. So they're not putting them into their portfolio. So not only is the Fed not buying, but then other investors aren't buying. And of course, we're seeing big security holders like Wells Fargo and other banks pulling out of the market, just further removing the buyers. And as long as there's no buyers, you're going to continue to see that spread. And it's going to take a while for it to come back into the averages, which is really a 1.65 to 1.80% difference between the 10-year treasury yield and the 30-year fixed mortgage rate right now. So as more buyers come in the market, or if the Fed starts buying mortgage-backed securities, not only will we have interest rates go down due to inflationary pressure, but we'll also have interest rates going down because of this yield spread. Which is really important to watch them both, because as we're watching inflation come down and we're looking at the initial jobless claims and we're looking at this spread, we can track where these numbers are headed and opportunities for a buyer. Those lower interest rates are definitely going to give a lot of our buyers not only affordability back, but bring more buyers back out into the market, holding up our home prices by putting the pressure on the supply, the limited supply. So here's the conversation that I'm having multiple times a day, right? I want to purchase a new home. I have a home. I love the fact that I have a 2.5 or 3% interest rate. I don't want to sell it. What does it look like? Not every home you have a 2.5% interest rate is a good rental. Just because it has a 2.5 doesn't mean you should keep it. This is the conversation that we're having because I have the number of investments I have, and because I work with so many investors and teach classes on investing. People are sending me all these conversations where we're helping somebody not only buy, but make the determination, do you sell? Because the answer isn't a flat no. And it really isn't a flat yes. It's a let's assess what the market rents are, what the appreciation opportunities are long-term, what your overall cost structure is, your ability to maintain that home should you lose a tenant, being able to offset the risks, the cost of holding that, the maintenance, the management fees, all of those things, right? And then converting it into an LLC, putting protection around it, getting the right insurance for that protection, setting up the right business structure. This is what my team does every single day. So if you've got anybody that's going back and forth on whether or not they should sell that home, and they're looking to purchase that next home, and then they're also looking at how to finance purchasing that next home, that's the strategy. Creating classes around, or conversations around, or newsletters around, or videos around, opportunities around maximizing what you have today. Now, everything I'm saying is not helping our inventory issue. No. But it is a real conversation to get doors open, to have you supporting your clients, whether they're purchasing today or simply need your advice because you're on their A team. Become their A team. Become that real estate agent that they call no matter what, because they know that if you don't have the answers, you have your A team who's surrounding you who do. That's why it's so critical to not only stay on top of the information, as Megan was saying, by joining our I was gonna say class.
Our weekly
Our
webinar.
weekly webinar. Now you gave me your
I know.
our weekly
Brutal day.
webinar every week. But surrounding yourself with those people that when you have those conversations, you can immediately turn those conversations over, knowing that the right information is going to support your client feel confident about their decision and be able to take that next step, because it's fear that holds clients back. Removing the fear allows them to take action no matter what the interest rate is, because it doesn't matter. Ultimately, the right time is your time, not the market's time. And we're constantly putting out videos around this. So this last video generated a ton of conversation around that, because we talked about the opportunities with both new builds and rehab loans, because those homes that aren't perfectly set up for the market are seeing opportunities, and they are starting to get some more buyer traction right now, because those buyers want to get those deals and they want to get the seller to pay their interest rate buy down. So as a reminder, we're in all 50 states. I'm going to stop sharing our screen, get out of here. And I don't think we have any additional questions.
No questions popped up, and
yeah.
we're 1 minute ahead of schedule.
Wow.
So this is amazing. So
Yes.
Thanks so much for tuning in this week, guys. We really appreciate you. We'll be sending out our updates. Nicole usually sends hers out around 1 or 2 in the afternoon.
Yes.
And then she posts her slide deck into the Agent Ignite group in Facebook. I will be sending out my report as soon as we sign off here and the video renders. I'll get you a copy of today's recording and a copy of all of the weekly reports. So if you signed up and registered for this, you will have access to everything going forward. We just got to thank you. That's about it. And so thanks for tuning in. Again, why do we do this, Nicole?
We do this not only because we're passionate about serving, passionate about educating, but we'd love to see your clients at the closing table. We'd love to continue to create that A team around you, because I know that if there's a question that comes up, if we don't have the answer and we bounce it between us a lot, we have the people that have the answers.
So please consider us for your next upcoming transaction, and we hope to see you at our closing tables in 2023. Have a great weekend, guys. Bye-bye.